Hello, everyone, and welcome for a little chat about risk mitigation. I've always thought the best form of defense is attack myself. So we'll be talking a little bit about getting on the offensive as well as on the back foot. Now, I just wanted to share with you, we have a huge audience tonight, currently at 26,275. 76, 77. So it's a very, very, very big audience. I'd like everyone to look around, shake hands with the person next to you and say hello to them. We're going to have an interesting little time here. And of course, questions are open. You might want to throw some up if you really must while I'm speaking, and I don't mind that at all because I can run off at a bit of a tangent. And also, if something comes to your mind, you can either write it down on your own desk or you can throw it up in the question box, and I will get to those towards the end, but I'll sort of keep an eye on that as we're going through. Oh, my name is Clifford Bennett, Chief Economist, ACY Securities. This is not personal advice. This is all about what's going on in the world in the art of trading, and your own personal circumstances, of course, are your own business, and anything you do in markets is 100% your own responsibility, and you can't blame anyone else for it. One thing that is guaranteed in markets, 100%, I give you my personal 100% guarantee, there will be losses. So moving on from that, I'm here to talk to you about risk mitigation. Of course, when we think of risk mitigation, one of the things that first comes to mind is stop loss orders, and they are essential. But a lot of people don't really understand where to put the stop loss order, because I'm going to sort of interrupt the pattern of a lot of things that tend to be taught in Trading 101 classes, such as you put your stop loss at 5% or 2%, you put your take profit at twice that or 3 times that. And I'm not really a big advocate of that type of trading, although it may work for you. Just checking the crowd size, it's 36,000 now. Thank you very much, everyone, for attending. So I have a slightly different philosophy in that I believe you should always be protecting your losses, but never limit your potential profits. In fact, I like to call my approach to trading unlimited upside. But in terms of the stop loss, look, you have to, before you even know your position size, if you want to mitigate risk really, before you take a trade and you decide on your position size, have a look at the price action, even if you're a fundamentalist, an economist, or you just love a certain company. Have a look at what the nature of that market has been over the last 3, 6, 12 months. And if it's the sort of market that frequently whips around at 7, 8% in corrections that you don't want to be stopped out on, it doesn't make sense to have your stop loss at some, sort of disciplined 2, 5% type deal or 1%, whatever it is, on every occasion, because you're just going to be stopped out. So if that is the case, you only really wanted to lose, say, 2%, but this market usually whips around at 7% on big corrections, then you're going to have to make it an 8% stop loss with a quarter of your usual position size. So the nature of the market, the particular specific market you're looking at, not a generalist rule across all markets, determines to you quite visually, quite quickly, quite easily. You just have to look at the chart and you'll see, oh, well, usually this market's had this sort of level of correction. I need to have my stop loss at least as large as that if I don't want to be taken out by one of those. And then from there, decide, okay, so I have to risk that many points. How much or how large is the position I can take as a result of that potential loss? So you work out your position size from the nature of the market you are trading. And that's probably one of the most powerful things you can do to mitigate risk or keep yourself in the trading game, in the investment game, in a reasonable manner. Now, some markets are so volatile that maybe don't have a stop loss, but just have a tiny, tiny small position and maintain the free will to get out at some point. I don't advocate that, but some markets maybe that would be something you would consider if it was a tiny portion of your overall portfolio. I always, as I said, approach markets from, I don't even put the trade on until I put the stop loss in. I don't buy something and then figure out where the stop loss goes. They go in together with the same click. There's always a stop loss. I've been in the markets a very long time, and I've actually had the experience of just having bought a lot of something for it to immediately have gapped lower than where I would have had my stop loss. And that's unlucky, but you know, we are also lucky in markets at times, but that is an unlucky thing, is it? Or is it a function of not having a stop loss go in with your trading position? So always do that. I'm actually a big believer sometimes, on occasion, in using stop loss orders to actually enter the position. So you might have a fundamental view of a market where it's going, but wouldn't it be nice if the market started to agree with you first, rather than you jumped in ahead of the markets moving in your direction that you expect? And so you put a stop loss buy order just above the market with the idea that you'll end up selling much higher. So you buy high to sell higher rather than buy low to sell high, which kind of brings us to what sort of trader are you? Oh my goodness, 102,000 participants now. I think that's enough. We did say if we got 100,000 participants, if at the end of this webinar, please do look under, we have put an envelope under one of the attendees' seats. If that envelope is under your chair, then please do open that and you'll find a key to a brand new Aston Martin SUV. Very nice indeed. So that's something to look forward to at the end of the webinar. So I was just talking about stop losses and the huge audience participation. And I think really when you enter a market high to sell higher, if you feel that comfortable with that notion, as I mentioned it, you're probably a trend trader. If you prefer to buy low, sell high, or sell high, buy low, you're a range trader. Now, one of the best ways of mitigating risk is to figure out what sort of trader or investor you actually are, because it's a little bit like there are dog people, there are cat people, and there are range traders and there are trend traders. And markets only have one of two sort of characteristics, really, or phases. They have the phase of being consolidation, which we know tends to chaos and randomness. The market's going all over the place very quickly. That's a consolidation phase. Or the general drift is sideways. Might be slightly up, might be slightly down, but it's generally a consolidation of a previous movement in the overall price structure of that product. The other thing markets do is what I just referred to, is that impulse trending phase. And in those impulse trending phase, there's less random price action behavior and more sort of reliable new high, pullback, new high, pullback, new high, or in a downtrend, the reverse, of course. So markets tend to random in chaos, but that's where very active range traders can do extremely well. You know, in the, not so much the minutiae, but more the cut and thrust of market trading, really getting in there. And that becomes quite instinctual. Of course, there's plenty of computer systems out there today wanting to do that sort of thing as well. And also very much looking to arbitrage different markets or different products of the same underlying market. But the range trader is someone who's more of a swordsperson, swordsman, swordswoman, who really is acting on instinct very quickly, cut and thrust. And that's a range trader. Range traders tend to be intense for concentrated periods of time, such as the futures pits of old, or these days on the screen, glued to the screen. Now, day trade could also be a trend trader, but what they're doing is they're not trying to buy and sell, buy and sell, buy and sell a lot. They're trying to get onto a position and build into that position. And I tend to equate trend traders to archers. So if you see yourself more as a swordsman, swords lady, or an archer, that will give you an idea of whether your natural background and abilities tend to lend towards one or the other. A lot of people suffer a significant risk drawdown because they're trying to be both. They're trying to range trade a market when it's in a consolidation phase, and then they're trying to trend trade a market when it's trending. And usually what happens almost inevitably is they end up trend trading a consolidation period and range trading a trending period, because it's just very, very difficult and too hard to do it. And most of us if you love both dogs and cats equally, maybe you could have a go at range trading and trend trading at the same time. But if you are a dog person or a cat person mostly, then you're either a range trader or a trend trader. It's just the way human beings are made up. And we've had different experiences, different backgrounds, and we have different motivations, which all create that mix. So what I'm alluding to a lot there is that trading markets is very much about you. In my book, Warrior Trading, many years ago, I said there's 7 billion ways to make money. Imagine that, 7 billion ways to make money trading markets. The trick is to find the one way that's natural to you. And now we're over 8 billion, I think. I haven't looked at the latest numbers. Certainly we haven't got all of them in the audience, but we will work towards that. So you have to trade markets. Markets are about what the economy is doing, then how markets themselves, the prices of various goods and services and financial products, are trying to relate and understand those economic outcomes and trajectories, right? So there's the economics fundamentals, then the markets themselves. Then over here, there's you, and between you and the market is the market interface. And you have to find the style of market interface that is right for who you are with your resources, your time restraints or abundance that you can apply to the market and all of those sorts of things. So be aware that markets, because we often get tied up with the idea it's just figuring out where the market is going. It is equally figuring out ourselves and how we're interacting with that market so we can stay true to a set of trading principles or a methodology that we have found works for us ourselves individually over a long period of time. Now, of course, as you develop all of this knowledge, it is great to be listening and learning from other people, but always be aware that when it comes down to it, it's about how you are interpreting all that information and how you're going to apply it. I think another big principle I could offer you is that, to me, markets are an accelerated version of life. An accelerated version of life. So any strengths or weaknesses that you as an individual have, the market will draw those out into your P&L for obvious consideration. It's a very bright mirror we look at when we trade markets and highlight those to you very, very quickly, which is why people can get into trouble, because we all have weaknesses. And if the market can find those and really highlight those very aggressively, and we're not ready for that, we can very quickly come unstuck. So just be aware of that. And similarly for our strengths. And when the market's highlighting our strengths, I figured out how to trade. I'm going to be rich. That's what happens to us. And then that's a character flaw in terms that we've let our ego run away with us, and then our market corrects that fall. So always remember that we have our biggest downfalls at the point of our greatest confidence. When you are absolutely confident, absolutely sure, it might be time to get up from the desk, walk around the block and have a rethink. I tell you what, one really funny little trick I used to use, and I found out years later that the biggest trader at the time on the Sydney Futures Exchange, he used to do it too, and we joked to each other that we had never told anyone else, is that, well, this is how old school I am. You could print off charts onto a paper chart and you could hold it up to the light and turn it over to make sure that you weren't pushing onto the picture of the chart that you were seeing your own internal bullish or bearish bias. So if you flipped it upside down, looked through it with the light behind it, if your bullish view turned into a bearish view, you're probably onto something. But if your bullish view, you still thought this chart looked bullish, then obviously you've got an internal bias happening, something to be aware of. Now, I'm not suggesting everyone runs out, buys a printer, because most of us don't have them these days, but and hold it up to a bright light, but it would be helpful. But it's also just to point out how powerful some aspects of how our brain operates can affect our trading performance. I'm sure many of you are aware that once we believe in something, our brains look for further evidence that that is correct, And we can sometimes, or whatever it is we're focused on, it could be a fear point as well. And we will tend to see more and more evidence to support that, which is why social media has run amok in the way that it has, because it's a natural functioning in the deep historical aspects of how our brain works that makes us filter everything else out and only hear what it is we're focused on at the moment, be it positive or negative. It's something to keep in mind. So when you're looking at markets, be aware there's a lot going on inside you that may work against your risk management policies. So just be wary of that. Be very aware that the moment you reach your point of greatest confidence, that's when you need to be a little bit worried. Other aspects of risk management, of course, are the global macroeconomic outlook. But if I'll just finish off on the trading there a little bit, because we're talking about stop losses. So one thing you need to be aware of is that the reason we have a stop loss is because things can happen we never thought of. They come out of the blue, they're unexpected. Or we could just be wrong. But a stop loss order isn't just in case you are wrong, it's also in case something unexpected happens. And if that unexpected event happens, the stop loss absorbs it. And of course, we can reverse for bearish positions, etc. The stop loss absorbs it quickly. You're out of the market. Not only does it get you out of the market, but it gives you the opportunity to rethink the situation. You could always want to buy back in perhaps, but it gives you an opportunity to rethink the situation and you can still play the game because you haven't lost all the tokens you had on the table first time round. So that's what a stop loss order does. Now, given that unexpected things can happen that work against us, it is equally true that unexpected things can happen that work for us. Now, what we tend to do is when the market goes against us, oh, that market was really hard. When we're making a loss, you know, the market was cruel to me. When we're making a profit, oh, look at me, I'm so clever. Right? We've got to really work hard not to have those responses to our P&L. Actually, I'll just digress here a little bit. Good trading is not making profits all the time. Bad trading is not making losses all the time. Good trading is sticking to a methodology that you have found works for you and suits all of your resources in terms of time, funds, you know, and just the way you want to be involved with the market. So you have to find that for you personally. Then once you do, and you found a way of trading in that matrix, if you like, that over time does give you profits, then good trading is having the discipline to stick to your methodology. Good trading includes losses. When you take a loss and you did it according to your planned methodology, pat yourself on the back. That's good trading. If you decided, I'm going to risk everything, and you bought a whole lot of stuff and the market went up and you made big profit, do not pat yourself on the back because that was bad trading. Okay, and we really are too hard on ourselves sometimes in thinking that losses are bad trading, profits are good trading, and it's that simple. No, there's good trading and there's bad trading. And if you're trading well, you're going to have losses. That's why at the beginning I guaranteed 100% losses. Good traders have losses. By the way, small aside, you might have heard it before in one of those sort of motivational talks, right? Michael Johnson, right? He had the NBA record of baskets, right? Swish, whatever they say, right? The record for the NBA. He also held the record for the most number of misses. He missed his shots more than any other player in history. But he also, because he made so many shots, he had the record for getting them right. So it just goes to show losses are part of good trading. Missing shots is part of good basketball. Don't be hard on yourself in that regard. Overall, of course, you want to mitigate your risk. So just always make sure you have stop losses. The other thing I'd say to you is if ever there's tumultuous events in the world, over the weekend, be sure to reduce your position size a little bit because you never know what may happen over the weekend. If, you know, a massive geological event, a major outbreak of conflict, who knows what might happen. Usually those sorts of things are negative. Sorry for sounding negative, but major events over weekends that dislocate markets usually are negative rather than positive things, though they can be positive too, which brings me back to what I was saying about stop losses prevent your loss. But what about the upside? What about when you get unexpected events that work in your favor? If you have a take profit order in the market, you will not enjoy that upside. You will not enjoy or participate in that unexpected positive event and tremendous upside that resulted from that. So when you put in take profit orders, you actually put in limit my success orders. I call what I do unlimited upside trading. Now, it may not suit you. If you're a range trader, this does not suit you. But if you're a trend trader, it can. So again, you have to think about it for yourself personally. So what I do is I always have a stop loss. I never have a take profit. I only use a trailing stop loss approach. So I'll lift my stop loss up when I can get it to break even. That's great, because that means I have a position in the market with no risk, and it could make who knows how much money. And if something happens that I never foresaw, but it works in favor of my position, I participate fully in that. Okay, so just that's another thing to think about. Unlimited upside trading, if you're a trend trader, definitely have your stop losses. Use a trailing stop loss. But remember, the tighter you pull the stop loss to where your position is, the more likely you'll get whipped out. So that's a really difficult discipline to get hold of. But just trailing stop loss, because you can see all this profit. Listen, early in my career, I was at State Bank New South Wales, and it was when options only just started to exist. And I took a $50,000 position on the euro, or was it the Deutschmark actually? I think it predated the euro, yes. So it was the Deutschmark, and that position went from $50,000 to $87,000. You know, and I was just playing with options then. I had other bigger positions. But it went to 87,000, then it went to 127,000, and the manager of the desk said, "You should take that profit. That's amazing. You know, you made over 100% on your premium." And I went, "No, I think I'll let it run." And I went up 200,000, 300,000, 400,000, 500,000, 700,000, $750,000. Everyone on this desk, and we're talking a large dealing room, about 200 people, but everyone on the desk was, "Clifford, you have to take profits on this." Like, that's a lot of money for the bank, $700,000 profit on a $50,000 investment. And it ended up going to 1.25 million, and it came back to about 875,000, then around 765,000, I think it was where I took profits. And some people had the hide to say, you could have sold it at 1.2. Wow. So if you had had that mentality at the beginning, you would have sold at 70,000. The only way you can make really huge profits if you're a trend trader is if you use a trailing stop approach, and mentally in your head, you are prepared to give a lot up at the end of the journey. If you try to pick that top, you'll never get as much as you could get in a really big trend by using the trailing stop loss and resisting that urge. Now, if you must do something, sometimes in markets, take profit on a third of it or half of it. Or if you're unsure of any position that's been working against you for some time and you started it without a stop loss and it's still sitting there for you in your investment portfolio, some shoebox stock, and it's well down, maybe just sell some of it. At least then, if it falls further, you won't be so psychologically disempowered, because you will have made a right decision. The thing about trading is you have to approach every day, every week as a fresh situation. If you have a losing day, and this is very much about risk mitigation, because you need to approach markets in this way, or you can confound your losses. And I did use the word confound on purpose, your losses significantly. As I said, if you don't think of your trading as losses are bad trading or profits are good trading, but you just want to be a good trader, a good artist, a good warrior, then at the end of every day, if you've had overnight positions or something, you come in the morning, or you wake up in the morning, you look at your positions, some have been stopped out, some haven't, or you've had one of those rare nights where everything's wiped out, you just dust your hands off and you start a new day unaffected by the emotion and the mood of those losses and that previous day. So important a skill to have. If you can have that skill, again, referring to BNP Paribas days, I might have had a loss overnight. I might have lost $750,000 trading overnight for the bank. And I'd come into the office in the morning and, you know, these were not big positions, you know, you can get a lot bigger than that, but but every, you know, position size matters proportionally. But I remember one night I lost $750,000 overnight. I came to the office, I was smiling, I was alert, I was happy, I was paying attention. And some of the other traders on the desk got upset and complained to the treasurer that I didn't care. No, I was happy, focused, alert, seeing what was going on so that I would be at my best today. Being at your best today is what matters, not worrying about the losses of yesterday, only in that they have lessons for you about the market and about you. Remember, both sides of that equation. Use that and move forward with confidence. The other, you know, thing, obviously, when I was speaking on AusBiz, a lot of it was about risk mitigation for if we're about to have some sort of global economic slowdown and some global equity market correction, which will probably impact cryptos. We've seen that happen time and time again. That's becoming an even more regular pattern, if you like. Cryptos are not a hedge against stock market fall. Every time the stock market falls, cryptos fall even more. So cryptos are the ultimate risk on, risk off appetite at the moment in the world. So I'd be very careful about seeing them as a hedge against anything. They are pure risk on, risk off. Do people want to be trading and taking risk? Cryptos will go up. If people are scared and running for the hills, cryptos will go down a very long way. So just be aware of that. But in terms of the global macro picture, look, I think this is pretty much how it's going to go, is that we're going to have below trend economic growth moving forward, and that will be a surprise to markets. Now, this is where I can make mistakes because I can see things like that for some reason, but I always underestimate how long it might take the market to recognize that. And first of all, the market would need to see a consistent data over a period of time, 3 to 6 months, maybe even 9 months, before it recognizes that that nirvana economic upside from where we are now, we had a great bounce back, but further nirvana economic upside from where we are now may well not eventuate. For people to recognize that is 3, 6, 9 months away. For us to know it now is a great advantage. I did suggest in the AusBiz TV show that if you are super wealthy, and I was thinking of people worth 300 million or more, or even, you know, sort of had 5 billionaires who've been clients over the years. I would actually be suggesting to people, you know, with significant wealth, take 90% of your chips off the table, because there is risk that there is something amiss with the world at the moment in terms of how it's valuing various products, which means for the wealthy, you should probably be looking, stress testing. I was suggesting your portfolio. If you had a 20% downturn in stocks and a 20% downturn in the property market, which I do not think is going to happen, I'm just talking about how to stress test your portfolio. If you could do that stress test on your portfolio, see how you're placed. If your heart rate picks up dramatically and you start to perspire and feel unwell or even dizzy, you probably have too aggressive a portfolio at the moment. Now, the way you can handle a too aggressive portfolio, of course, is either you can lighten the load a little bit, sell some assets, or you can use these fantastic modern day financial instruments, CFDs and index futures and things, to actually go short in the market. I know people who have physical stock holdings. Whenever they think a market is going to go down, they don't unload their physical stock holdings. They actually sell CFDs and they hedge via financial instruments. And then you can use a trailing stop down on that hedge. And if that market turns around, you might end up having the great pleasure, and I'm not saying this is definitely going to happen, but you may well end up having the great pleasure of your hedge against downside made money, and now your core holdings are making more money than they would have otherwise. So risk mitigation is the path to long-term success. How you view risk mitigation will be different to every individual, but certainly it's something to keep in mind that for the moment, the world's very excited about the upside. Can that be sustained? Yes, it can. It's been sustained for longer than I thought initially that it would be. So I've got that a little bit wrong, but lately I've been yelling hard and loud from the rooftops that there are signs that there could be a top now. Now, if I'm again wrong, well, I apologize for that, but I would rather warn you and get it wrong than not warn you, because you wouldn't like me if I said to you after it happened, oh yeah, I knew that, but I forgot to tell you. Okay, so I am going to shout that when I think it's a real probability, and I think it's still in play at the moment. The NASDAQ, all the US stock indices have just had a massive rally, but the NASDAQ only bounced back to about half of its falls. So it could be yet another, still this sort of, it could be the right shoulder, a head and shoulders formation that's occurring in US equities markets at the moment. And that would allow for a little bit more upside actually in those indices and various stocks in the US. But the rally that we've seen does look a little bit tired. And I was a short-term trader here. I'd be selling a little bit, which I have done. I've sold a little bit, and some of it's working and some of it isn't. So I have my stops above the recent highs in New York, just in case, and a little bit wide on that because I know it's going to be volatile. So you're taking into account the kind of market behavior that's happening. But I guess, the key point to take away from this is that it really is about you. And the better you understand that you're an individual with individual traits interacting with a market, and therefore, how do you determine that interface? And certainly all the financial tools are there for you to do so. And I'm just going to sort of wrap up my comments here, and then I'm happy to take any questions that you might have. But do be aware that as an individual trader and investor, you have a massive advantage over the likes of Goldman Sachs or Lloyd's or UBS. You've got to remember the GFC generated a situation where all the major hedge funds and investment banks, the people in those organizations were desperate to keep those jobs because there were a lot of layoffs at that time. So they engineered a whole new evolutionary outburst of committee structures. The purpose of committees, of course, is that everyone in a committee can sort of say yes, no, and the committee makes a decision. And then if it goes wrong, well, the committee made the decision, it wasn't me. It's a little bit why people have outside advisors. You can blame the advisor if it goes wrong. You can blame the committee without taking personal responsibility, which means you have a higher probability of keeping your job, which means you underperform. You have to understand that a lot of these organizations are the biggest fund managers in the world, a lot of them a bottom quartile on the performance stakes. It's the individual trader and investor who can think for themselves, look out the window, apply common sense to what's going on in the world, realize at the moment there has never been a crazier world. I've been doing this for 34, approaching 35 years, started when I was 2. So there has never been, from real experience all through that time, there has never been a crazier time in markets where there was so much information, overwhelming amounts of information. That information is chaotic and all over the place, a great variety of views. Never before has there been so many inexperienced, though inexperience was an advantage over the last 18 months, inexperienced people touting themselves as market experts. One thing I'd really like to say to you is that whatever markets have been doing over an 18-month time frame, if someone tells you a black box that says this system made this much money over the last 18 months, be very careful of that, because individual markets often change their behavior in a kind of 18-month cycle. So just keep an eye on that and be aware of that. And also be aware that each and every market has its own humanistic, organic, if you like, nature of behavior. So try to take that into account as well. Mitigate your risks by always having a stop loss. Mitigate your risk by enjoying unexpected profit periods by not necessarily setting quite an aggressive, if any, take profit orders, and mitigate your risk by thinking ahead. If this happened, if this happened, if that happened, how would I be placed? Would I be able to cope? Now, an aspect of that I haven't spoken of, and I'll just finish up here in case there's any questions, is that if you plan ahead, you can behave and act decisively and sensibly in real time. If you haven't thought about it in advance, the strategy of how you will behave in a certain set of circumstances, which stop losses help us to have that discipline. If you haven't done that, then in real time, you're going to be overcome by the emotion of the moment and not make the same sort of decisions you would if you were level-headed, calm, and had a steady hand, if you like, at the time. That's all from me. I'm just going to have a quick sip of water, and if you have any questions at all, please do let me know. And we just cracked 165,000 attendees. Thank you very much, everyone, for attending. Okay, questions, please. Here's one. So if you're trading crypto, would you recommend you actually have a stop loss, or is it better not to? You have to have a stop loss. Your leverage, and we're good like this, your leverage has to be extremely modest, and your stop loss has to be all about how that market has been behaving lately. And I guess one of the advantages of crypto trading is that you could have a reasonably tight stop and take a reasonably small loss. But if the market runs your way, as we know, it can run a very long distance indeed. But certainly take a look at the price action, think about how much you're prepared to lose on any individual trade and how many of those trades it would take to wipe you out. You don't want to be wiped out by getting it wrong 20 times in a row, because guess what? What you don't expect to happen often does happen. Okay, someone's just saying the Australian dollar's been falling for a long time. Would you get out of that position now? I did go on AusBiz on Tuesday morning and I said the Australian dollar was due for a bounce. It would be a good bounce. We've seen one so far. I think it could rally a little bit further. But overall, I think the background fundamental pressures on the Australian dollar are indeed massive, as you will see in any of my reports or videos that you've been reading, watching. So I do think the Australian dollar rally is a rally to sell. Whether it's a rally right here, ending right here or not, I'm not too sure. And someone's just asking, how far could the Australian stock market fall? Well, 7,000 is not that far away. I think we could do that. I think we could do 6,800 on the AUS 200. And then it would be up to whether there was a broad global meltdown. Now, people don't like me talking about a broad global meltdown, but can I just say, remember I said earlier, your point of greatest confidence is when you are most exposed to a significant setback. You could apply that in a very broad sense, the entire global investment community at the moment. And also be aware that a lot of the global financial media are really about making sure everyone's excited about markets and everyone's continuing to buy into markets, because a lot of their advertisers, of course, are selling superannuation or investment products. So just be mindful of that, that there is an inbuilt bias, if you like, to the media system. You know, in New York, in Manhattan, by chance, there's an area that's called, you know, the hedge fund block. It's probably 2 blocks by 3 blocks, but in there's over 1,000 fund managers that manage in excess of $1 billion. And a lot of them obviously manage 30 billion, 50 billion, 100 billion and more. So that's a lot of money in a concentrated area. It's not too far from where the financial news media groups are, and it's not too far from where the investment banks tend to be located. And that matrix of investment banks, hedge funds, and media is very much something to keep in mind. And often when you hear of very high level celebrity status globally, if you like, fund managers and people coming out and saying, this market's going to crash. For instance, I'll say his name, Soros came out some time ago, and many years ago this happened. And he made this big thing about how gold was going to crash. And the moment he did, it was like, that was today's big news on Bloomberg, Wall Street Journal, or whatever. I contacted all my clients and told them to buy gold because to me it was obvious that if he was now doing that on the media, he already sold everything he wanted to, all his friends had, and the banks he was selling through had also sold as much gold as they were ever going to want to, which meant that they had all become nothing but a sea of potential buyers, and therefore buying gold was the right thing to do. And of course, gold just kept going up from that day ever after. So do be careful not to be too much of a meme trader and just following famous people because of what they've said. You don't have to worry about me because I don't have a big enough following, but do be mindful of that. And do remember the biggest organizations are not necessarily the smartest organizations. Just because Goldman Sachs said something or UBS said something, or my old employer BNP Paribas in France and Trading Room in London says something, it doesn't mean it's going to happen. They are struggling as much as anyone else. Now, there's a couple of questions still to go for a couple of people, but I think I'll get back to them individually. Is there any fresh questions left to go? If not, look, I want to thank you for listening to me share some of my personal thoughts on markets. Of course, I'm not getting it all right. Not everything you heard tonight actually is correct, but I believe it to be correct. And that's another trick to markets. You have to understand that what we believe, we have to leave the door open a little bit. Yes, that's how we see things. Is that right? You have to always be reflecting back in on yourself as well as figuring out where the market is going. Thank you very much for joining me. I really do appreciate it. Clifford Bennett, Chief Economist, ACY Security. Thank you.